Welcome, everyone. Today, we're going to be talking about tax strategy for the beginning investor. And I have with me today the team at Brandon Hall CPA and my personal accountant. Let's get started. Two, one. Welcome, everyone. I have with me today my actual accountant, my personal accountant, a team that I met some time ago, and it was in my journey of trying to find a tax accountant that actually knew what they were doing with real estate and, for the small investor. And so I'm fortunate to have him on today to talk about, if you were a beginner, how would you go about getting your tax strategy in the right place? So Tom, how you doing?
Not too bad. Thanks for having me on the show today.
Yeah, likewise. It's always, fun to see the same first name in our titles here.
Absolutely.
So cool, man. So, I had a guy on about, I don't know, a month and a half ago and whatnot. And we talked about more strategic elements of tax planning, the bonus depreciation, real estate professional status, all that. So I think today I want to keep it more high level. For those who have no idea what we're talking about in the last episode, I want to hit on some just key concepts, some viewpoints as a beginner. If you were going to start doing tax planning, I guess, where would you first start as an investor?
Yeah, I think the first place to start is your accounting and bookkeeping system, believe it or not. And the reason for that is where you're going to be able to determine what your net income is at any given time, and that's going to determine how much tax you pay. So keeping a pulse on that's important. It's also important for making sure you're maximizing your tax deductions through all the expenses that you can track, and being able to categorize them into categories, for lack of a better term, that are optimal for tax purposes. And that really starts with the source of truth, which is the financial information you have about your business, in this case real estate. So that's the
Yep.
first place. That's the first place to start.
Yep. Yeah, I agree. I mean, as you know, from doing my returns, I am still not as organized as I would like to be. But over the past 2 years, I've really started hammering down on just organizing the numbers, because it's amazing. I mean, even small things like, as you get an expense receipt in your inbox, if you have a business that you can relate it to, forwarding it to that inbox, that those simple moves, at the end of the day, if you're doing that across the board, tracking your expenses every month, it makes the year end tax time a lot easier, I assume.
No, absolutely. And it's just, if you put those little, like you said, you put those little things in place, it can make it quite easy for you to do. It's just something that I found in my experience, a lot of investors who are beginning to invest, they look at it as something that's unimportant, or it's just a waste of time. And I understand that it feels like a waste of time when you're doing it. But then when comes down to the time when you actually need that information, you have to go back and try to resort it all out later on. Just makes it all the more difficult, and probably not as accurate as it could be. So it's
Yep.
just it is a big component of your tax situation for sure.
Yep. Agreed. So, okay. So step one, get your numbers in order, understand where you're spending. And if you have a business, what expenses should be allocated to that business versus personal. Awesome. Okay. So beyond that though, I get a client, they come to me and they say, Tom, I have high taxes. Do you have any ideas as to how I could reduce those taxes? And without going into bonus appreciation or any of that, what would be some just general ways? And again, each person is case by case, but what are some just general strategies that off the bat someone could begin to consider?
All right. So is kind of two ways to look at this, I guess. So the first one is, it all depends on your personal situation, but let's just assume you are full-time in a business that's not real estate, or you have a W-2 job, right? At that point in time, the main things open to you to be able to reduce your taxes are retirement accounts, charitable contributions, HSAs, the standard stuff you're going to hear about. The tax, the IRS, the Congress, the IRS, U.S. Treasury, all of that, they did away with a lot of the tax shelters that were around in the 80s. So there's no more magic pills that really exist. You're just getting down to these simple strategies of like I just said. So like I just mentioned. So those are the strategies that are going to help you. Now, when it comes to real estate specifically, the one thing that's really powerful about real estate for pretty much any real estate investor is that you can increase your income without increasing your taxes. And what I mean by that is, when you are investing in real estate, there's depreciation. We won't get into the details of that, but there are expenses that are non-cash expenses that could put you at a loss, and where you could really have operating, basically your cash flowing. So what I mean by that, let's just say that you have $10,000 in rental income. You have $4,000 in hard expenses. So property management fees, repairs, maintenance, these are dollars that are actually leaving your pocket. And then you have, say, let's just say a $6,000 depreciation expense, no cash. So now you're at a net loss, but you really cash flowed $6,000.
Mm-hmm.
So by the point of all this is by investing in real estate, you're able to increase your income without increasing your tax rate, or the amount of taxes you pay, your effective tax rate. So real estate investing in and of itself is a good tax strategy if you just want to keep it surface level like that.
Yep. Yeah. Yeah. Agreed. I mean, that's been my journey. In fact, I'll just plug your firm this year, but I historically have paid taxes, right? And this year I was like, oh man, I'm expecting a really high bill. And I think from all the real estate that I had, and you guys were able to make it work, I ended up getting a return, which I'm still worried about. I'm like, how is that possible? So you guys did something right, but yeah, it's phenomenal the power of how that's set up from the depreciation. Yeah, it's to your point, it's essentially paper losses, but pocket cash flow. So,
Exactly.
yeah, that's awesome. Okay, so step one, again, get organized, get your things in place. Step two, consider assets like real estate. But let me ask, so if someone says, I don't want to own real estate, it's too much of a headache, what else can I do to still earn income and have some tax sheltering? Is there anything else like real estate, or do you have a second asset that comes close?
Yeah, I mean, I can't say there's a second asset that really comes close to it. It's outside just general business ownership. If you own a business, you can write off a lot of other things that you couldn't if you didn't. So, for example, you could write off part of your cell phone bills, part of your your internet, part of your vehicle. So, I mean, this is a car you might drive personally, but you're able to write off part of it under a business. So, and there's a lot of other expenses like that, that come with the benefit of business ownership. So general business ownership would be like the second, I guess, to real estate. And depending on the business you own, you can actually get depreciation from those businesses as well. If you own like a fitness center, for example, there's a lot of fixed assets in there, a lot of the equipment. And then same thing like laundromats, asset heavy businesses, except the difference I will say between a business and real estate is that if you say you own a fitness center, those weight machines, while you're depreciating them, actually aren't going to appreciate in value on the market. They're actually going to, their market value will traditionally actually be lowered along with the depreciation. Whereas in real estate, traditionally, while you're depreciating that asset, you're actually the market value of that is going to increase. Through inflation or forced depreciation, whatever renovations, whatever type of strategy you're employing, that's the difference. And so I can't say, and that's why real estate is so powerful as an investment vehicle, because you get all these benefits that are in many ways unique when you factor them all in together, combined to real estate.
Yep. Yeah. I mean, that's a great point. Depreciating those assets is actually a loss because they are selling for less on the market because they're used. Whereas real estate, at least in the United States, tends to go up in value. So it's depreciating an asset that is actually appreciating, which is somewhat hilarious when you think about it. That's definitely a fascinating point. So one thing that I came into when I first met you all, and really awesome of your team, but you guys sent me a bunch of resources. You said, hey, here are common things that we run into. People don't have time. They don't have ways to organize things. And it could be better if they did. So you sent me some resources, and if you don't mind sharing, what were some key resources that you tend to send to clients, such as like the apps or books that you send them to help them out?
Yeah, I think the first thing is some key apps. Mile IQ is one that we often recommend, and there's other ones out there like Everlance could track your business miles. Most people before like the advent of smartphones would have it on an Excel spreadsheet or a handwritten time log. Kind of tedious to keep in place, but the Mile IQ could really help you maximize your vehicle's deductions, because every mile that if you use the standard miles deduction, not getting into too many details, but you get 57.5 cents per mile as a deduction. So just having that in place will save you a few bucks come year end. Expensify is another one. It makes it really easy to take a picture of a receipt. The IRS does require you to keep receipts over $75. And for meals, they require you to keep all receipts. So to avoid the proverbial shoebox of receipts, which people actually do have, it's not just like a myth. It's very common. You could just take a picture of the receipt, and Expensify will store it for you. And then you have QBO. Or bookkeeping spreadsheet. When you first start out, you can have all you can manage a bookkeeping spreadsheet for your properties. But eventually, as your properties grow, you're going to want to look into a more robust accounting system that has some automations in it. Just things that's a little bit more organized. Just it's an accounting system, and we would recommend QBO for that. QBO Online, you can access it from anywhere. So those are a few resources. Then other than that, there's books you can read, of course, on taxes. Tax-Free Wealth by Tom Wheelwright's a good one, of course. It's a good
Hold
book.
on now. Look, I agree. It's a great one, but his program's like $20,000.
Oh yeah.
To essentially get like an hour consulting session. It's so.
Yeah. Look, it's a good book. The book's like $20, probably less.
Yeah, it's true. It's true.
So I will say this, and it's the brand name that's able to generate those, but the premises, the stuff he lays down in the book is a good way to think about business, from a tax perspective, at least. So that's a good book. We have a tax strategy blueprint we send to our clients based on their specific situations, which is basically which tax strategies are specifically going to help you minimize your taxes. And we because there's like a sea of tax strategies out there, and not all of them are going to apply to every individual.
Yep.
So what we do is we summarize basically which ones are actually relevant for you. We do all that sorting out for you, and that's what we provided. I mean, and there's just general books out there on taxes. You could just find them online. There's like NOLO has a few good ones.
Mm-hmm.
So those are some of the resources we typically send clients. We also have some other spreadsheets we may send out from time to time.
Yep. Yeah, agreed. In fact, your spreadsheet that I use for my properties is really, I mean, it's pretty robust for being, an Excel sheet. So awesome. Yeah. And there's a book, I think it's called Every Landlord's Guide to Property Management and Taxes.
There's NOLO.
I think it's NOLO.
Yeah, it's Every Landlord's Guide to Tax Deductions. I think it's called.
That's an awesome one. So you guys told me to get that one. I got that one. It had to be a crazy year for you and the team with all the changes and the new extensions for filings and everything. Maybe hit on some, one or two trends that you're seeing in the market in terms of just, tax strategy or what your clients are doing to maybe get ahead of the curve. What are some key things that you're seeing for either a potential change in office or just general tax strategy going into next year?
Yeah, that's a good one. So for what we're seeing, so the CARES Act introduced something called so before the Tax Cuts and Jobs Act of 2017, you were able to carry back NOL. So an NOL is a net operating loss. So let's just, quick example what that would look like. Let's say that your business, let's just consider it a business, generates a loss of $100,000. That loss is going to offset any other income you have. Now, let's say after it offsets your income, now you have $0 of income in that given year. And let's say it's still a $100,000 loss. You can carry that back up to 5 years to pretty much get a refund on some of the taxes you paid in the past. The Tax Cuts and Jobs Act wiped that out and said now you can only carry it forward up to 20 years. The CARES Act put in place for 2018, 19, and 20 that you can actually go back now and carry back an NOL. So what we're seeing is a lot of our clients who are real estate professionals, who are truly real estate professionals, that is, trying to generate as much losses as they can this year in hopes of getting an NOL carryback. And I will say we have a handful of clients who've done that, but the majority have not. It's very hard to actually generate an NOL. It's not planned. It's usually not a planned event. It just happens. So that's what a lot of our clients are trying to do. A lot of our clients also who suffered adverse financial consequences as a result of COVID are also looking at ways to liquidate their retirement accounts, their 401ks, their IRAs. You could take up to $100,000 if you meet certain requirements. and spread out the tax over 3 years. So people are taking their money out, looking to reinvest that into real estate, hopefully this year. Outside of that, there's a lot of speculation going on, and that's purely what it is at this point. About if depending on how the election goes, some of these depreciation, some of like
Yeah.
the 100% bonus depreciation might phase out much quicker than than it currently will. So there's a bunch of clients that we have trying to basically maximize the depreciation they could take now, where they maybe wouldn't have if the election wasn't pending. So.
Yep. Yeah. I mean, gosh, I mean, they're all good points. Yeah, the carryback is a really powerful instrument. I'm not quite there. I could be, I guess, but I feel like you have to buy a pretty big asset that carries a loss initially, or I guess you could buy a a sizable newer property and then carry the bonus appreciation as a loss. Which again, for folks that are listening that are beginners, the carryback and the bonus appreciation. I mean, I don't know, Tom, what your opinion is, but it has to be two of the most powerful instruments out there in tax.
Yeah, so yeah, bonus depreciation, the real estate professional status. If you're a real estate professional, those two things combined are probably the most powerful thing in the in the tax code right now. And then when you add on the potential for an NOL carry back to that, I mean,
Yeah.
you're rocking and rolling, and it could be extremely powerful if you have the resources to acquire assets that large and to actually wipe out your income in 1 year, which is, like I said, it's a very small fraction of our clients are actually able to do that. It sounds sexy. It probably sounds sexy as we're talking about it right here, but it's not an easy thing to do.
Yeah. Yeah. That's fair. So I want to close up the session, talking about, if you're a beginning investor and you're interviewing CPAs and whatnot. Now I'll put it out there. This firm does have some parameters with which they apply the process to select their clients. But if you are lucky enough to get with them, fantastic. If you're not, there are others out there. And I guess when they go out to market and they're interviewing people, who should I work with? Like, how do I know that they're a good CPA? If you were in their shoes, what were just maybe 2 or 3 questions that you would want to be asking to make sure that you're dealing with the right firm?
Yeah. So if we're talking in the context of real estate, you're going to want to ask, what's your experience with real estate? How many real estate clients do you have? What niche are they in? What are the size of their portfolios? Basically, what you're trying to do with that question is just gauge, does this firm have the expertise to best suit me as a real estate investor? And it would go for any industry. You could just kind of like
Mm-hmm.
plug and play there. That's the first thing you would want to ask for. Second things you want to ask is, who am I going to be working with? Because you want to make sure that that person or that group is going to have that expertise as well, and that's important to know the background. You also want to ask, of course, price. How do you price? Is it fixed? Is it hourly? You want to know what's the financial commitment to working with that CPA firm. You also want to ask for references, of course. You want to ask for reference who is a similar person client as you. So if you have 5 buy and hold rental properties, you want to ask how many people have you worked with in the range of 5 to 10 rental properties who I could talk to. And you're gonna get a good idea of what it's like working with that company, working with that CPA firm if you do that. Some other things to kind of ask is, what are the timelines for things? If I sign up with you today, will you be able to file my tax return by a certain deadline? If you need it by a certain deadline, how much information do I need to provide you? How am I going to provide you that information? What's my role in this? Like as the client, what do I have to do? What are you taking over? Those types of questions are probably where to start, and that's where I would start.
Yeah. That's those are all solid questions. I'll just put you on the spot, and I won't get your hourly rates, but what do you think is a reasonable range of hourly rates or a fixed cost for a general small investor? Maybe they have one or 2 properties. What would you say would be a fair price?
Yeah, I mean, that's kind of hard to say.
Yeah.
It all depends on who you're working with, of course. But I would say that if you have 1 or 2 properties, if you get a tax return done for like 1,000, to like $1,200, you're probably in a good spot. Um, because here's the issue, right? There's two types of firms out there. You have generalist firms who just do everything, and they don't have a focus. They just do whatever comes their way, they'll do, and they don't ever really dive deep down into things. And it's just to them, a tax return's a commodity. It's just numbers on a paper form, file it, that's it. Other firms are boutique firms who have a specialty niche, and those firms go deep into one area, and they're able to really understand that area really well and maximize the tax savings you can get as they file your tax return. And there's value to that. And so I guess it ranges. If you're going with a general CPA firm, anywhere between, and I'd say $500, $900, you're looking at probably a good spot for someone who has like one or two properties. If you're going with like a boutique firm, you're gonna add a few $100s to that price, because we're going with a group that really understands what they're doing, and that's what I would say. One last thing I'd say on that too is you got to look at it. There's a lot of things when you're first buying a property, the way it gets reported on your tax return is going to impact your tax situation down the road, and you want to make sure that stuff's done right up front. And you have to look at it as almost an investment into your business, and not just as an expense on a line item expense. So that's what I would say. But bottom line is, if you're going to go with a general CPA, somewhere between like $500-$900, like 1 or 2 unit. If you have 1 or 2 units, probably good. If you're going with a boutique firm, you're probably going to be looking at $1,000 to like $1,200.
Yeah, that's fair. And again, team, that means no Jackson Hewitt. That means no H&R Block.
Oh yeah. I mean, look,
avoid those places.
Yeah, I would avoid those places. Yeah. We've seen, not terrible all the time. I mean, firms like that. Firms, I'm saying that with air quotes. So there's relatively low standards. You need to actually be a tax preparer. You could, like anybody off the street, can pass like basically a test. Essentially,
it's essentially data entry.
Yeah, it's just data entry, and a lot of those firms, a lot of those like H&R Block type places, it really is just churn and burn, like just put numbers on it. They don't really have any deep knowledge of the tax code. So I mean, they even sometimes miss very basic things just because of the nature of their business. So those firms definitely want to avoid it. I'll say this: like, look, if you don't have any properties, or you maybe just have one property, you can get away with a firm like that probably. But like, as you start to get more advanced, you have more and more properties you're accumulating. If you're investing as a limited partner and beginning a K1, that's when you need to start looking for a CPA. And whether it be a generalist or a boutique firm, you need someone who knows what they're doing, because those things start to get more complex. Like anybody with a W-2 can go file their tax return, TurboTax, and be fine. I've done it for years, and it was really so simple. I'm like, I didn't even need to be a CPA to do this. Anybody could do this. But when you start to get into more of the complex areas of business and real estate, you need to go with a professional.
100% agree. As you said, it's not really a line item. It's a strategy advisor as part of your power team, and it's an absolute essential need. So awesome stuff, man. So soon, in the next few months, the team at Brandon Hall CPA, including Thomas here on the call, we'll have a course for everyone, and we'll get more into those details. And I think once you have it out to the market, we'll get you back on to talk about the course and how that can help some people starting out. So that said, sir, appreciate the time, and let's do it again soon.
Oh, thanks for having me on.